Well, good morning, West Coast, Central, and Mountain. Good afternoon to everyone else. My name is Brad Etheridge, and I'm the Chief Marketing Officer for the Center for Tax Strategies and Resources. We're happy to have you with us here today. We're going to do kind of one of our preliminary lead-up mini webinars that leads up to our large event that we have that starts this Monday. We'll tell you a little bit more about the Virtual Academy as we go through the program. We have about 40 minutes together or so, including some time for questions and answers. You'll notice on the right side of your computer screens, you have an opportunity to be able to ask questions during the presentation. Our staff will do their best to answer most of those questions during the program. We'll pick up on the ones we missed toward the end. At this point, for those of you who don't know Simon Singer, I'll do a quick introduction. Simon's been successfully in our industry since 1966. He's in the top 10th of 1% of all financial advisors in the U.S. and has been there for quite a while. Several business bestsellers. He's a sought-after speaker and an all-around pretty darn smart guy. And he's the chairman and founder of the Center for Tax Strategies and Resources, as well as Advisors Consulting Group, his company based in Encino, California. With that, I will turn it over to Simon to introduce Mr. Givner.
Well, thank you, Brad. We've got a unique opportunity today because I was able to convince one of my friends in this business, who's one of the preeminent tax attorneys, to come help us educate us a little bit about how to minimize or eliminate long-term capital gains and estate tax. But he's also going to speak a bit about how he works with professional advisors and how, as a team, we can create greater results for the client and for our own practices, as opposed to being worried about deal killers. However, before that, Mr. Givner also happened to play a part in one of the major historical events of the 20th century, and that was the Watergate break-in. And he wrote a book called My Watergate Scandal Tell-All, How I Unwittingly Caused This Historic Event. For those young people on the phone in the early 70s, there was a break-in of the Democratic National Convention Center, and it wound up. It ended up with the resignation of President Nixon and Gerald Ford taking over as president. But in any event, Bruce is one of the preeminent tax attorneys in the country. He is one of the more creative, problem-solving attorneys that you will ever run into, and he's very favorable to people in our industry as well as the accounting industry. So it acts as a very, very special bridge. So Bruce, you can start wherever you want. You can start with you making toll-free telephone calls to girlfriends from Washington, D.C. back to Los Angeles, or you can start telling us about capital gains and estate tax reduction. It's up to you. Mr. Givner.
Thank you, Brad and Stuffy. I think I'll talk about capital gains tax planning. I'll make a short introduction of about different ways to reduce, defer, and eliminate capital gains taxes. Then I'll talk about why that's important to advisors and how they benefit from being involved in the process. And then, time permitting, we'll go through the slides and just give a brief overview of what we'll talk about in the more extended session on the, I think, Tuesday, is that the 18th, 17th? Anyway.
Yes.
So, at least in theory, there are as many as 21 ways to reduce, defer, or eliminate capital gains taxes. And when I talk about that, I'm not referring to, well, included in the group is, of course, very commonly talked about and understood 1031 exchanges, but I don't really talk about that much because our clients certainly are not interested in doing 1031 exchanges. We represent mostly wealthy real estate families, and a wealthy real estate family is one that buys and holds or builds and holds real estate, and those families don't sell, they just hold. So we get people who come in the office and they want to do a 1031 exchange, and we have an expert in the office who does that. Well, one of the other 21 ways of reducing, deferring, or eliminating capital gains tax, of course, is death. And the potentially new administration, and by the way, I'm not making political comments. My job is not to talk about politics because I know if I do, I'm going to irritate either 60% or 40% of my audience. So, but a potential new administration, they are talking about eliminating step-up in basis at death, which, by the way, will make this conversation about ways to reduce, defer, or eliminate capital gains taxes that much more important. So if that happens, I suspect what is now 20% of our practice, which is dealing with capital gains tax planning, that much more important in the future. So in any event, when we talk about capital gains tax planning, to choose among those potentially 21 methods, we look at three factors. The three factors are the size of the gain, because a lot of the techniques are based on the installment method of accounting. And when we talk about the installment method of accounting, of course, think about your home mortgage, which is installment payment over 30 years. So if Steffi wants to sell something for, let's say, $10 million, there's many ways he could do it on an installment basis. He might say, Bruce, I'll sell it to you for $10 million, interest only for 10 years. Well, that's an installment sale. Or he might say, I'll sell it to you for $1 million a year over 10 years. Well, that's also an installment sale. So a lot of the techniques do involve an installment method of accounting. And there's this rule that virtually nobody's ever heard of, and it's section 453 capital A of the Internal Revenue Code, which says that you can't create more than $5 million of installment notes per person per year. So if the size of the gain is, let's say, $400 million, that installment method doesn't get you very far, husband and wife having $10 million limit per year. And if they've got some children, we can get it up to 20 million. And if we're pretty creative, which we are, we can get it up to 30 or 40 million. But it's not going to do you a whole lot of good with a $400 million gain. So I said there's three components we look at. One of them is the size of the gain. A very important component is the timing of the gain. So if someone comes to me on Monday and says, my deal's closing on Friday, that's very difficult, because most techniques don't work in that kind of short timing period. And the government has weapons that it can use if you set up something on Monday and you close on Friday. Those techniques you've probably heard of, like the assignment of income doctrine, the step transaction doctrine, the lack of economic substance doctrine. So we try to train our referral sources to listen for the client saying this, I'm thinking of selling in 2, 3, 4 years. We teach them to say, stop, let's go see Givner right now. And that's helpful, because if they come in more than 2 years in advance, there's many more techniques that are available, and the techniques are both more conservative and the clients like them better. The last of the three elements, we said size, timing, is the nature of the asset. Think about S corporation stock. You know that only so many kinds of people in trust can own stock of an S corporation. What if it's a C corporation? Well, the buyers really only want to buy the assets of a C corporation. They don't want to buy the stock, because if they buy the stock, they know they're buying into whatever labor law violations, tax fraud that the owner of the stock committed while he was owning the C corporation. So the buyers really only want to buy the assets. So now you've got this double tax, right? Let's say the corporation has 10 million of assets and has a zero basis, and the shareholder has 10 million of stock, fair market value, with a zero basis. Oh my goodness. So the corporation gets $10 million right against zero basis. So it has $10 million of ordinary income. There's no capital gain for a corporation. Well, in California, that would be a 28% state and federal tax. So the corporation is left with $7.2 million. Well, if you liquidate that out so the shareholder can get the 7.2 million in California, that's a 37.1% tax on 7.2 million. Well, what are you left with? Answer, 45 cents on the dollar. That's a combined 55% tax rate. Not very attractive. So when the taxpayer comes to me and says, what am I going to do? We call it a double banger, because we're trying to step up the basis in the corporation's assets to minimize the tax. And we're trying to step up the basis in the shareholder's stock. Well, you can't always do that, and sometimes you can only get rid of one of those two. So again, timing, size, nature of the asset. That's how you start helping the client narrow down the 21 potential techniques to the 4, 5, or 6 that might actually work. So,
Bruce, let me jump in for a second. So before, you've taught me this now, we've been doing this for 30 years. So before you do any kind of a strategy, you first want to either reduce or increase the value, depending on what it is you're trying to accomplish. Is that right?
it's the basis, not the value. Yes.
Thank you. Thank you. And in doing so, that's when the creativity comes into play, because the strategy itself is the same as pretty much everybody else has got. It's how you get there.
Let me quote Simon Singer to you. And that is that we don't create anything. We don't use trusts on Pluto or corporations in the Cayman Islands. We have very few techniques. We use installment sales, we use corporations, we use partnerships, we use trusts. It's how we time, combine, and sequence those techniques. That's our intellectual property. It's the timing, combining, and sequencing of known techniques. I'm quoting Stuffy Singer when I say that. So, make sense to you?
Well, it made sense to me, because all those years when I had great difficulty understanding what you were talking about, and still do, I had to create a rationale for why does this work? And for the people on this call, the tendency is to be intimidated by somebody with Mr. Givner's level of intelligence and creativity. And all I can suggest to you is don't be intimidated, because you don't have to know this stuff inside and out. You just have to know a few bullet points as to how to get somebody interested, and then let him take over.
And I think that the more you understand the technique, when I'm talking about the person, I'm talking about the tax lawyer, the more you understand the technique, the easier it is to explain it to the client. And basically, if you can't explain the technique to the client in about 2 minutes, then you really don't understand the technique. You should be able to make it pretty simple. So let's talk about how do the other advisors benefit from the technique. And of course, it depends on who the other advisor is. But what Stuffy said is, you got to deal with the deal killers. Who are the deal killers? Well, the number one deal killer is almost always the CPA. And so you've got to motivate the CPA to get involved on the good side. And when you're doing capital gains tax planning, well, the first thing is the CPA gets involved in the counseling up front. And so there's a lot of billable hours for the CPA to be involved in the counseling, because you're going to spend 2, 4, 6 hours just talking to the client through the possible alternatives. You've got to do discovery, right? You got to learn all the client's goals, all the client's objectives, and certainly all the facts. You may have to review a whole bunch of documents. So the CPA is going to be intimately involved in that, assuming the client has a good relationship with the CPA. And if the client doesn't, one possibility is you reach out to the CPA, and the CPA is very thankful to be involved. Sometimes, unfortunately, the client has no confidence, in the CPA, and that may be an opportunity to do a referral to a CPA who's a good referral source to you, whom you know is very competent. So that's one way for the financial person to, make a good thing for the financial advisor, right? So the CPA will get billable time up front, and then depending on the structure, there's going to be complexity, and the CPA will get a lot of billable hours every year thereafter for the trust, keeping track of the payments, and it could be thousands of dollars on an ongoing basis for the CPA. So you're going to have a good friend from the CPA whose billable hours up front and ongoing are going to increase. So make that person your friend. What if the other advisor, most important, is a lawyer? Well, I'm always respectful of that other lawyer. Most commonly, it's an estate planning lawyer, but sometimes it's a business lawyer. Well, the estate planning lawyer, again, because I come in as the tax lawyer. I hate it when someone says, Mr. Givner's an estate planning lawyer. No, I'm not an estate planning lawyer. I'm a tax lawyer. About maybe 4% of our practice is doing estate planning. And estate planning is who gets what and how did they get it on your death. And that's the living trust and the pour over wills. We do a little bit of that. And when clients come to us and they want to change their living trust, we help them with that. But when we get involved in the estate area, we're taking $100 million or whatever it is and reducing it down to zero. We're not dealing with who gets what and how do they get it. We're trying to eliminate, and we know how to do that, to eliminate the estate tax. We don't reduce estate taxes. We try. By the way, you can't always eliminate estate tax. And by the way, when it comes to estate taxes, I 100% believe in life insurance. People are in it. Everyone who walks in is underinsured. There's not even a question of that. So I'm not an estate planner. I'm a tax lawyer. And when I make that clear to the estate planning lawyer is happy. And one of the ways we make them happy is upfront, just like a CPA in the counseling process. And they like that. And the other way we make them happy is we have them prepare a bunch of documents, because very often there's a children's trust. I'm not going to go into that right now, but when people come in, what Stuffy always says is they don't come in to save capital gains taxes and give up control. Everybody who comes in, their most important goal is to maintain dictatorial control of all of their assets from now till the day they die. So if you can't show them that they're going to maintain dictatorial control of all their assets from now till the day they die, they're not interested in doing the planning. So you first have to convince the parents that even though you're setting up a children's trust, which we may have the estate planning lawyer do, right, to make the estate planning lawyer happy that he's getting billable time, if you can't show them that they're going to maintain dictatorial control, they're not going to be interested in doing any kind of planning, whether it's asset protection planning or capital gains tax planning or estate tax planning, right? So, and also the estate planning lawyer can be in, there's other documents the estate planning lawyer can do. I'm working on a transaction with one of Stuffy's colleagues in Colorado, and it's a very complex capital gain structure. But we came up with the local counsel in Colorado doing virtually all of the documents. So they're not deal killers, and they're happy. And the clients are happy because they have people with whom they're familiar doing the documents. So we're getting paid a lot of money to make sure it's all coordinated, but everybody's happy. And Stuffy's colleague in Colorado is happy because those lawyers don't view him as taking away their clients. Because my biggest, the most important thing to me is to make sure that Stuffy's colleague is happy. And if he brought in a lawyer from outside who took away all this billable time, they might not be happy with him, right? So what about if it's an insurance agent? Well, one of the things is that if the capital gains tax is not paid, on $10 million, the minimum in California would be $3.3 million. But if it's a personal residence or if it's stock of a C corporation, it would be $3.71 million. Well, if we make that capital gain go away, what's the benefit for the insurance agent? Well, that's a bigger estate. It may need more life insurance. And if the insurance agent also makes money by assets under management, that's a whole lot more money to manage. And some of the techniques we use involve very definitely to make the capital gains tax go away, the sale of life insurance. So that's another way to do it. And some of them involve private placement life insurance, which is assets under management. So there's an ongoing revenue stream for the insurance agents.
Bruce, let me jump in. And it's a revenue stream that didn't exist before one of our members got involved enough with the clients that they were willing to pick up a phone at least and speak with you. Because when you reduce tax, you increase budget. When you increase budget, all of a sudden the statement of, how much of X, Y, and Z, how much assets under management would you give me? How much life insurance would you buy if I got the government to give you the money with which to make the payment? And that's effectively what you're talking about.
And in these techniques, where we almost invariably, now it's not 100% of this capital gains techniques, but in most of them, we need a children's trust. And when this money is building up in the children's trust, there's no difference between a children's trust and an ILIT, an irrevocable life insurance trust. They're just names. So the children's trust is the ILIT, and the children's trust now has all this money it can use to buy an insurance policy. So what's not to like? So as we look forward to, I don't mean look forward with great relief, because you might or you might not be looking forward to the November 3rd election, look at what might change. So what might change is that there will be, if there's a change in the Senate and the presidency, tax rates may go up. there's talk that if there's a change, that capital gains rates may be eliminated. Maybe capital gains would be taxed at the same rate as ordinary income. Wow, if that happens, we're going to be doing a whole lot more capital gains tax planning. And as I said earlier, if they eliminate the step-up in basis at death, I know exactly how to deal with that. And that's going to make us do a lot more capital gains tax planning. And if you're living in California, the legislature right now is debating a bill. This is actually related to capital gains because in California, we don't have a capital gains tax rate. Right now, over $1 million, the rate is 13.3%. Well, the bill they're debating or arguing over in Sacramento will increase the tax rate by 1% for people who make over $1 million. So imagine, your client has a $5 million capital gain. It's now going to be 14.3% over $1 million. But wait, there's more. If your gain is over $2 million, it's 3%. Holy moly, that's a 16.3% non-deductible California income tax rate. There's more. If it's over 5 million, it's 3.5%. So that makes it 16.8% over $5 million. What if your client has a $15 million capital gain? That means the last 10 million is going to be taxed federal. Oh my goodness, crank calls at 16.8% state, plus if they eliminate the capital gains rate, 37% federal. Let me see, 37, 47, 53.8%. And if they don't materially participate, what did I come up with? 53.8. That's 56.8, and it's more than that.
Well, wait. And that assumes that Congress doesn't increase the tax rates if a certain party.
That was the increase. That was the increase of capital gains from 20 to 37. That was the increase. So, in any event, do you want me to spend a little more time and go through the slides? What would make you happy, Mr. Singer?
Yeah, you're making me happy right now. But if you can click your way through and show them what you're going to go into in great detail in 2 separate sessions at the Academy meeting that we've got on Monday, Tuesday, Wednesday.
Okay, so when ready, it says show my screen, but I don't know if that's what I want to do, Todd. Is that what I want to do? Okay, let me try. Show my screen. Okay. Where's the slides? They seem to have disappeared. So Todd, if you can show the slides, I would be very happy. Otherwise, we can sit and look at my Olympic weight stack in the background there.
So sophisticated tax attorney does not necessarily mean having great levels of business acumen operating a computer and a slide deck. Todd, Can you run those for us?
Any event. So here's how we talk about capital gains tax planning. The introduction for the client is we say, if capital gains tax planning was the only concern, and it's never, if capital gains tax planning was the only issue, and it's never the only issue, what you would do is you would sell this $10 million asset for a 30-year interest-only installment note. Why is that perfect capital gains tax planning? Because you don't get your $10 million for 30 years. You don't pay the tax on the $10 million for 30 years. But there's
Bruce, let me interrupt. I think I heard you say 3 years, not 30 years.
Sorry, 30 years interest-only installment note for the $10 million. And that's perfect capital gains tax planning because you don't pay the tax on the $10 million for 30 years. But there's 2 problems with it. One is you don't have your $10 million. The other problem is you got to trust the buyer for 30 years, which you don't. So how do we cure that problem? Well, we set up an irrevocable trust for the benefit of the children. And if they don't have children, they have heirs. We sell that asset for a $10 million interest-only installment note to the heirs trust. And now the heirs trust, which just paid $10 million, sells it to the outside cash buyer for cash. So now what does the parent have? They're very happy. They have the $10 million of cash in the children's trust, which they dictatorially control. I'm not explaining that at the moment, but they're happy. And it looks like the children's trust paid no tax because it paid the parent $10 million and it got $10 million. So that looks like a good result. But there's one problem with that, and that is you can't do that. Why can't you do that? Because Congress says if you sell something to a related party and within 2 years the related party sells that thing, the related party doesn't get to use what it paid you as its basis. So if you sell to the Children's Trust on Monday and the Children's Trust on Friday sells to the cash buyer, the Children's Trust basis is the same as the parents, which was 0. That didn't work. So how do you get around that? Answer, the rule that Congress wrote into the code says if you wait 2 years and 1 day, boom, it works. So what's today, August 14th? So if we set up the trust for the children on August 14th, 2020, and we sell the $10 million asset to the Children's Trust on August 14th, 2020, and the Children's Trust doesn't sell it to the cash buyer until August 15th, 2022, it works. The Children's Trust pays no capital gains tax. That is a terrific technique. The parents love the technique. Having the $10 million in the Children's Trust is almost the same as having it in their own pocket. The children get nothing as long as the parents are alive, unless the parents want them to get something. So that is the most conservative technique you can do, and the parents love the technique. They aren't dealing with any outsiders. Everything is within their control. Now, what's the problem with the technique? Well, there's a couple of problems. One is it doesn't work for a $100 million capital gain real well. Certainly doesn't work for a $400 million capital gain. The other problem is if the business is going like this, if it's just taking off, then in the 2-year period, the appreciation is going to be so much, it's not really going to save that much of the capital gain. But if you've got a fairly steady business, you've got a fairly steady piece of real estate, and if it's 30 million, 40 million, it's a wonderful technique. The other basic problem is, unfortunately, most people don't come to us with 2 years and 1 day in advance. But even when they tell me they've got a buyer, I still describe that technique because a lot of people, 25%, say, wow, that's great. I'm going to take my building business off the market, let you do that technique, and I'll sell in 2 years and 1 day. So there's a lot of people who think that technique is so good, they call off their sale. By the way, the pandemic has made a lot of people into believers in that technique. They thought the business today was worth 20 million, and they were selling it at the end of the year for 30 million. Well, those deals, a lot of them are dead. The business they thought was worth 20 appraises at 10 because of the pandemic. And they're not selling this year or even next year. It may take 2 years to recover. So we have a lot of people who all of a sudden are setting up that Children's Trust and waiting 2 years. So how much more time do you want to take there, Mr. Singer?
Well, I'm going to ask you and I'm going to ask Todd whether or not we can get through the slides to give them an idea of the scope of information for the ultra sophisticated folks in our audience, and for regular people like me, how many slides you get to go through so I can see the things that are going to be talked about. I just don't know whether you can get through them or not.
I can't see how to manipulate slides, so I'm going to go to the next structure, okay? Mostly you don't have 2 years in a day, okay? So what if you get the client in 2020 and you can set up the structure this year, and then next year you can do the sale? What if you can do it 1 year in advance? Wonder if that works. Does that allow me to do it? Okay, so what if you have 1 year in advance? Well, we use a structure involving a partnership, and this is really good because family limited partnerships are estate tax planning structures that are well respected. And so the good thing about this technique is if you do it properly, if you spend the time to do a good job, it looks like estate tax planning, and we file gift tax returns in connection with it. But the basic idea behind the structure is you drop the asset into a family limited partnership. The initial partners are mom and dad, 97% limited partners. you got the Children's Trust, which is a 1% direct limited partner. And then the Children's Trust owns an LLC, which is the general partner at a 2% GP interest. Now, the goal of this structure is to step up the basis of the asset that you shove down into the partnership. And how do you do that? Well, you do it by selling, mom and dad sell limited partnership interest to the Children's Trust. You get an appraisal, of course. Let's say the asset is worth $10 million. So you sell 90%, mom and dad sell 90% of the limited partnership interest to the Children's Trust. Well, if you're truly doing estate tax planning, you would want the biggest possible discount in the sale of those limited partnership interests. And typically, we can get about a 40% discount for lack of marketability and lack of control. But when we're doing it for capital gains tax planning, we want a lower discount. And about the least amount of discount we can get is 15%. I'm going to use 10 for this example because I can't do math really well. So if you're selling 90% and you get a 10% discount, that's 90 times 90 is $8.1 million, okay? So the Children's Trust pays 10% down and a 90% note for $8.1 million. So what you've done through something called a Section 754 election is the basis in the assets in the partnership steps up to reflect the Children's Trust purchase of the limited partnership interest. Wow. So now you've taken it from 0 to $8.1 million. Now that's not perfect. You haven't stepped it up to 10 million. Stepping it up to 8.1 million is pretty good. So as long as you wait to the following year and you do a good job, I mean, you made it look, touch, smell, and feel like estate tax planning, it works pretty well. So the first structure we talked about, which was the sale to the Children's Trust for a 30-year note, that gets you about a 90% step up in basis. This one gets you about 75% step up in basis, but it's a really good result. And it allows you to do it this year and sell next year. Now we can go to techniques that you can set up this year and probably have the sale occur this year. So there's a lot of structures. And when we go through this in the full seminar, we can go through there's very specific diagrams that go step by step through all these techniques. So the partnership technique, the reason why that works is because what you're selling to the Children's Trust is not what's being sold to the outside third party. So that's one way of getting past the related party installment sale rule. Now we can talk about the several techniques where you're not selling to a related party. So you're not stuck with that 2-year and 1-day rule. Well, there's various types of unrelated parties. What's an example? Well, nieces and nephews are not related parties. Siblings are, but not aunts and uncles. So I've done many structures where a best friend comes along and you sell to the best friend for $9.5 million, and you don't right away do this, but the best friend months later sells for 10 million. So the best friend makes $500,000 on it. But if you do a good job, document it properly, that works because there's economic substance to the transaction. So you've got to make it look, touch, smell, feel like the best friend or nieces and nephews or trust for nieces and nephews is not the agent of the parents, but that can work also. Then there are professional third parties out there who do this for a living. For example, there is something popularized by Stan Crow, and it's literally, if you Google his name, S-T-A-N-C-R-O-W, you can find his website, which has maybe hundreds and hundreds of pages in which Stan has answered every question, responded to every critique of his program. What Stan does is let's use $10 million. He buys your asset for $10 million interest only at 5.61%. Promissory note, but it's unsecured. Ooh. He then sells your asset for $10 million. And by the way, he can close this transaction in 2 weeks. But he sells your asset, he keeps your $10 million of cash. And what do? Well, you take Stan's note and you go to his unrelated lender. It's a hedge fund. And they will loan you $9,350,000 of non-taxable loan. So what happened? You sold it to Stan for an interest-only note, and you walked away with $9.35 million of non-taxable loan proceeds. What do you pay the lender? 6%. Well, 6% interest on $9.35 million just happens to actually coincide with the 5.61% Stan is paying you on $10 million. You're not out of pocket a penny. And now you've got $9.35 million to invest for 30 years. If you make 5%, wow, if you make 6, 7, 8, 9, 10%, you have made a fortune. So in 30 years, if Stan pays off, and Stan's going to be 105 in 30 years, so let's say if his children pay you off, you will have a lot of money to pay off the original tax on $10 million. If he doesn't pay you, you don't have to pay back the loan. That's a pretty good deal. It's very sexy. What are the problems with it? Well, it's an installment sale. So you got the same problem you do with any installment note. It doesn't work very well for $100 million. For 5, 15, 20, it's really nice. What's another problem? The IRS may think it's too good to be true. So we send our clients to a very prominent lawyer in a prominent New York City firm. And for 75 to 100 grand, he writes you an opinion letter, which we think you need to have. There's not much for us to do in these transactions. And Stan's been under audit by the IRS since 2015. Now, why is it the IRS hasn't done anything? We think Stan has done a good job and the IRS doesn't really know what to do. So the audit hasn't gotten anywhere. Now, there's at least 1 or 2 other groups that have stolen Stan's idea and they've mimicked it. Stan hasn't gone after him because, arguably it's not patentable or, trade secrets. So there's other people who are not being audited by the IRS who do the same thing. So that's one example of a professional third party who's not related, okay? There's yet another third party transaction called the Deferred Sales Trust. So if you put that in quotation marks and Google it, there'll be a lot of hits. But the one you want to look at is myept.com, which used to stand for myestateplanningteam.com.
It's Binkley, right?
Say again?
That's Binkley?
Yes, that's Robert Binkley created that, B-I-N-K-E-L-E, or it might be K-E-L-E-Y. And what they do, it's not terribly sexy, but it's very conservative. Let's say you have a $10 million zero basis asset. They have a lawyer and they have a CPA, and they assign one of them to your transaction, and that person sets up an irrevocable trust, which benefit that person's children, and trust buys the asset from you for a $10 million interest-only installment note. The interest rate is something negotiated with you, and it should look like what you expect to earn on the money. And that trust then sells your asset for $10 million cash. And now, over the course of the next 10 years, it's invested. You have a money manager. I don't know the exact details because I've never been involved with one. You don't really need me involved, okay? So I think what happens is of the 1% money management fee, your person gets 70% and they get 30%. They charge a legal fee up front, which is something like 1%, and they charge a trustee fee of something like 0.3%. So it's not terribly expensive, not terribly sexy, but I think it's conservative. And they say they've done 2,000 of those over the past 20 years, and they have like $1 billion in various trusts. So a lot of people must like it. Not terribly sexy, but pretty conservative. You want to stop at this point, Brad? Oh,
yeah.
Okay.
Yeah, actually, I don't want to, but I don't want, you've only got about 15 more minutes of material total in your office and in your brain. So I'm saying that with my tongue firmly in my cheek. So why don't we save that for next week? You know, Bruce has been one of 3 tax attorneys that we've had doing these little vignette webinars. They're all going to be presenting at the Academy. We've got a couple of CPAs that are going to be presenting. There's going to be technical, there's going to be psychological, there's going to be sales. It just so happens that we're taking advantage of COVID, but we might wind up staying with these virtual programs because we've had massive amount of response. Brad, why don't you take over and tell the folks a little bit in the next few seconds? Got to unmute yourself, Brad. Can't hear you, Brad. Okay, I'll do it. The Virtual Academy is going to be held August 17th to the 19th. That's next Monday through next Wednesday. It starts at 8 a.m. Pacific time. It's scheduled to end at 3 p.m. However, there are some breakout sessions, some for members and a few for non-members, and it's an approximation as to the end time. We tend to run long. For more information, you can call 877-258-2837. Todd, can you switch me to the next slide, please? Maybe you can, maybe you can't. These are the speakers that are going to be there. You can take a look at them. You can read as well as I can, but it's 20 speakers. It's about 21 hours worth of content. No, it does not qualify for continuing education, but it does certainly qualify for helping to increase your net practice revenue, your ability to create relationships with professional advisors. Bruce will spend some time talking about that on Tuesday, I believe, is when he's speaking. But every one of these people are at the top of their class, from marketing to computer stuff to CPA. It'll be an amazing event. Todd, can I go to the next one, please? So just remember, a little help can make a big difference. If you're making 150,000 right now, we believe that if you will let us help you, we can get you to 300,000 relatively simply. And likewise, if you're making 250, we can probably get you to 500, and the numbers grow exponentially. It doesn't take much, and strategic alliances, which we'll spend some time creating, because Bruce and I have been strategically aligned for 30 years, and it started out with a very talented tax attorney and a talented insurance guy talking about some subjects, arguing about some subjects, and eventually created a strategic alliance that's been very beneficial for each of us, as well as the CPAs that we come in contact with, as well as the, I'm going to call the members, but the associates that we've garnered across the years. 3 hours, 21 hours of training. It comes down to about $23.50 an hour. And Mr. Givner's current price right now is about $750 an hour, as is Mr. Strazzeri's, who's one of the other tax attorneys. Next, Todd, please. So you can go to www.yourctsr.com and click on the upcoming events tab. And if you throw in this promo code, we made this a very complex promo code in order to make things more difficult. In the next 48 hours, the code is V as in Victor, L as in Larry, A as in Apple, G as in Go, VLAG 817. You get an additional 15% off, which brings it down to about $420. Or you can call 877-258-2837 or email the center team at yourctsr.com. Bruce, just personally, I really appreciate you spending your time doing this. It gives you a break from just walking around the house pretending like you're a dog. You know, this COVID virus has made us all very much like dogs. We walk around the house looking for something to eat, and if somebody mentions going for a ride in the car, we get all excited. Hopefully that will be over relatively soon. By the way, I forgot to mention that one of the speakers will be one of the preeminent research infectious disease doctors who's been working on the COVID virus, as well as he worked on the HIV virus with Dr. Salk. He's a dear friend of mine and my personal physician by the name of Jeff Galpin. He's going to be speaking on, I think it's Monday, on a separate session that everybody will be able to have access to, ask him questions, learn what's going on, eliminate the political BS that we're all hearing. If you've got nothing better to do, and I don't think you do, I would strongly suggest you come along to this. So, Bruce, again, thank you. Brad, thank you for your hand signals. I appreciate everybody's time. Thanks again. Take care. Bye-bye.